Hi everyone, it's Grant Abbott speaking, and welcome to it should be the Guru's Guide to SMSF Auditing Independence. For me, when we start to have a look at this, we're going to start to see there's so many twists and turns. There's so many different bits of legislation coming in. I had a couple of questions from people over the last maybe 3 or 4 days. I thought, okay, I'm going to hunker down and really get into this. And I know I've got my good friend Tim Munro on at the moment. So, Tim, it's going to be interesting to see where we go. So what I've done is I've pulled everything apart. Interestingly, one of the key requirements for competency standards in providing advice to SMSF trustees under the Corporations Act, that is if you're licensed, is that you must meet the competency standards for outsourcing. So we've got to look at the SIS guide and on auditor independence. We're going to have to look at the Corporations Act guides in relation to audit independence, APS EB, so that's the Australian Professional Ethics Standards and Accounting Board. We have to look at their new standards, which have been made in consultation with CANS, IPA, and also the CPAs, which I've had a look at it, and it's going to blow you all away to smithereens. But before we get there, we need to really get involved and start to look at some of the legislation, etc. Selma, like to know if there's a minimum number of audits a registered auditor must sign off on. Let me go and have a look at that when we go through. So really good question, Selma, on that one. Again, that's all encapsulated in Division 1A of Part 16 of the SIS Act. So we've got a blend between the SIS Act and also the Corps Act in terms of registration of auditors. Now, I know there's a few auditors in there, but here's the first thing is all of us, if we're advisors to SMSF trustees, are equally responsible, listen to this, we are equally responsible to ensure that our auditors are independent when they deal with our clients. So there's a two-edged sword there in that one is we can rely on the auditor, but the other side is also we need to make sure that the auditor is sufficiently independent from us. Otherwise, we end up right in the midst of our SIS Act. So let's go forward. Please ask a lot of chats along the way. Now, I just again, this is I do most of my slides on the morning of the session because it enables me to really get my thoughts fresh. But the issue of audit independence has suddenly got very hot and very quickly. I mean, it's been around for a long time, and I think most of us have seen clients or accounting firms, and it's still going today, where there's supposedly a Chinese wall. You know, we've got one partner or one manager who's doing all the SMSF audits, and then the rest of the other partners are preparing the financial statements, etc., in relation to that particular issue, which we're going to have a look at. And of course, it's always been an issue. The Commissioner has been really up in arms about that for a long time. I suppose it's never really been a big issue. Well, first off, APRA, or the Insurance and Superannuation Commission, looked after SMSFs way back up until 1999. And effectively, it was sort of like, well, they didn't really know what they were doing. So no one really got audited. There was only a couple of real cases at that time, such as Holloway's case and a couple of small ones. But from that one is, you know, when we have a look at those particular issues, the tax office took over. The first 10 years, the tax office has just been really getting their bearings. Then they started doing a lot of, I suppose, quite detailed explanatory guidelines, rulings, etc., bulletins, which have been great. And it's only been the last 3 or 4 years where there's been a fairly intense focus on auditors, SMSF's compliance. And we saw that, remember, with the investment strategy, which now is bigger than bigger than Ben-Hur. And we're right in that midst of auditing season. So the wash-up we're looking now is going to have a dramatic impact for everyone. So again, the tax office are now starting to get very ornery about it. If you saw at the recent summit that we did, the strategy summit, I had a big long session with Steve Keating around it, and he noted that they're obviously getting really heavily into this audit independence side as we're going to start to see, and a lot of enforcement. The typical one is that obviously that Chinese walls, some people thought, well, why do we do that when we could just, for example, if I've got an accounting firm, and I know my mate Tim's got an accounting firm at Change Accountants, I have my SMSFs, he does mine and I do his, then that should be okay. So reciprocal arrangements. Now, there's a lot more from that that we're going to have a look at. So all of it looks seemingly above board, and you know, I think the main thing is that all of us wanted to keep in control our auditors, because what happened is a lot of auditors, and I know Selma, you're an auditor and all that, but really the competency standards of many auditors leave a lot to be desired. You know, they're 3 or 4 out of 10. And the issues about that is that they tend to say no and qualify audits when they really don't know what they don't know. And that's an issue for a lot of us. So when we have a look at it, we've got to look at, you know, we've tried to keep them friendly, but we've also got this overriding concern built within the legislation, which I want to look at is, you know, what is a non-complying self-managed superannuation fund, and in particular Section 42A of the SIS Act. So we need to start to getting deep diving. But then, you know, suddenly out of the blue, well, not out of the blue, you know, they've been working on it for a while, but the professional accounting bodies and APESB decided to draft up a guideline in May 2020. They call it the Guide to Independence. And I must admit, it was only just recently brought to my attention, which is very naughty for me. I think I've probably been doing a few other things, but mind you, that was only like maybe 2 months ago. But look, I spent all day on it yesterday and this morning, and it's quite shocking. But let's get into that a little bit later on. But what we need to do is look at it in the broader context of the impact on trustees, their advisors, licensed or not, because as you'll see, and I'll prove to you, is that we're actually all in this together. Our decision to appoint an auditor or advise a client to have an auditor is just as important as the auditor itself. So if the auditor is not independent, and we're aware of that, particularly now that these guidelines are out and about, that's the problem. Is once these are out, it's much the same as a Commissioner's investment strategy ruling. It's now public knowledge, and you cannot say that you weren't aware of it, because as a professional and a competent professional, you're supposed to be aware of it. So it means that if you're aware of it and you know there's a breach of independence, then it's actually going to peel back on you, and you're the one who's actually going to end up getting sued. Now you can see here, I've just put in a little thing. As I said, things are getting hot. 22nd of April, Asic moves against SMSF audit misconduct. And look, I'm sorry if any of these are friends or clients of yours, but you know, Ken Hacker of Queensland for significant audit independence breaches. Sophranios of Lahos of New South Wales for significant audit independence breaches. Stephen Sproats of New South Wales for significant audit independence breaches. Mark Higgins of New South Wales for significant audit independence breaches. So you see this comes out every month, and there's the guideline that ASIC is just bumping these guys off, and there's probably about 6,000 orders. I think there's going to be a lot more come to play. Personally, I think there should only be, once we get in the guidelines, there probably should only really be 20 big auditing firms in Australia. So there's my rub on it. Let's have a look. We've got there up Jason Spitz. We've got ATO is essentially going to look at the auditor independence. That was on June the 25th. Then we've got a whole lot of other ones. This was just taken from today. SMSF auditors and bodies face up to independence. Large scale reciprocal auditing expect to be ATO's radar, and we've got all of that stuff. So again, people are just putting their hands up and they're getting a bit of airplay from it. But there's only one way to actually look at that, and it's to do a deep dive, get down into the weeds. So I've done a lot of structuring around this. So I'll just take you through what we're going to go through. I'm going to give you the guidelines that we are looking at here. This is obviously being recorded, so you'll be able to access it at a later stage, which is really important if you want to go into a deep dive. But again, if we're looking at this stuff, there's a lot of stuff, you can read a lot of that crap, but at the end of the day, it's important that we end up in a position that we do understand what the law is. So I need to focus in on the start of the SIS Act. I want to look at approved auditor and also what the governing rules of a superannuation fund, because you're going to find that the approved auditor and the standards there are part of the governing rules, which are important. What is non-compliance? I'm going to look at section 42A of the SIS Act and have a look at that. Many of you may not be aware of that. I always teach that in my 4-day course, which I haven't done for such a long time. My online course is there. All of you who are strategists, more than happy if you or any of your staff want to go through that 4-day course, just let us know, and that'll be gratis for you. Then we need to go from there to Division 1A of Part 16, and in particular Section 128F in terms of auditor independence, so it's enshrined within the SIS Act. Then what I want to do is, I'm not going to go into any great thing, but Asic Regulatory Guide 243.2, Asic basically says Asic's got the responsibility for registering approved auditors, setting competency standards, imposing any necessary administrative outcomes. As you saw, I mean, this is probably, can't get much more than an administrative outcome around auditors being disqualified. But the ATO monitors the conduct of SMSF audits. In some cases, may refer an auditor to ASIC to consider taking further action. So ASIC is like the judge and the jury, whereas the Australian Taxation Office is the police. And that's a pretty tough one. I mean, it's it's a horrible one to actually be operating under. But again, when we have a look at this, it's virtually, when we look at this side, the auditors are in fact working independently, but they're working more for the tax office and ASIC than they are for the individuals. We're going to have a look at 54C and 55.3 just to see, well, what happens if something goes wrong. We're aware of there's a breach. We know the auditor's potentially a problem. You'll see, for example, in our firm, if we've got 100 SMSFs and we've got one auditor who does all those 100 SMSFs, and effectively they might only have another 100 thereabouts from a number of other firms, that auditor is no longer deemed to be independent, or it's going to be very hard for them to show their independence because of the nature of the volume of work coming from one client. They may well be independent for the other firms they're looking at, but if they're just doing predominantly yours, and that's their main auditing function, then basically you're going to be pretty well out of the independence gateway, which again, that sort of comes around that reciprocal arrangement, is that if I do yours, you do mine, and I'm the only auditor, and the only audits I do are yours, then effectively there's going to be myriad breaches of the independence guidelines. So we're going to go through that. I don't want to jump too far down the track, but I have to peel it back into effectively section 54C and 55.3 to see if there is a potential liability for us that we are, if there's an action, the auditors have a problem, what the action is back on us. Then we're going to be looking at Fnss, so this is the financial standards for SMSFs, 505, which if you're licensed, you must meet this competency standard. It's published by the Australian Industry Skills Council. So you have to support the trustee in the selection and performance monitoring of outsourced services, which also includes obviously administration and audit. So we've got to be very careful about that one. So we're starting to look at the SIS Act, our liability, and I'm not talking about auditors here, we're looking at SIS Act, our liability as advisors, outsourcing to an auditor or recommending a particular auditor, and how we can all get swept up. And then, of course, we're going to look at the independence guide, so we'll look at that. So that's what we're going to focus in on today. So let me just go in and start to peel in. And what I'll do is I'll put these, all of this information up on our website. If you haven't seen it before. Actually, I think if you haven't seen it before, you'll just be able to go to our website here. You should be signing up all the time. Have a look through these weekly webinars anyway, and the webinar schedule. You'll see there that we've got tomorrow is the motor vehicle lease agreements, but there's a lot there. Equipment, motor vehicle, living wills are coming up. What happens to companies on the death of the founder, which is really important. I know, Tim, we've done a lot on incapacity, but what happens on the death? Advanced healthcare directives, the living trust, which is pretty important. So have a look through those if you want to join up. But from our perspective is when we look at this one here, we'll have a look at, it'll be in the strategy centre, and then we'll find it in the strategy centre down at the webinar videos. So you'll be able to see, as strategist members, you get to go live. Here's the two last ones. Remember, I did part 1, part 2 of the LRBA case study. This one will probably go in today, and then it'll have all the attendant information with it, so all the relevant documentation. So let's start at the start and have a look at the SIS Act, and more importantly, Section 10.1. So when we look at the SIS Act, all the big definitional stuff like related trusts, governing rules, there you go, adopted child, all of those things you're going to find. Let me just open it up a little bit further. You're going to find all of those things in Section 10.1. Again, this is a pretty late one from the compilation date. It's 23rd of June. Just sometimes I've been working on old ones and found myself in a little bit of hot water. So just make sure you're always up to date on this one. You can get, it's probably too late, I was going to say, you can get the Australian superannuation legislation from CCH for 2020, but virtually the year's almost over now. So let's go through and have a look at approved, where are we? I think it's, maybe I've got, okay. So the approved SMSF auditor, I'll just mark this up for you guys here. An approved SMSF auditor means a person who is registered under Section 128B, but does not include a person for whom an auditor disqualifying a person from being an approved SMSF auditor or suspending a person's registration is in force. So effectively, once you're an SMSF auditor, then effectively you're still treated. Obviously, then there's the disqualification. I want to go down a little bit further here and have a look at the definition of governing rules. So GHI. So let's go here. So the governing rules in relation to a fund scheme or trust means any rules contained in the trust instrument, other document or legislation or combination of them, or any unwritten rules governing the establishment or operation of the fund, scheme or trust. So what we need to do is we need to have a look at, it's part of the, obviously the laws under the SIS Act, that we need to appoint an auditor, and as a consequence of that, effectively when we appoint an auditor, that is part of the governing rules of the fund. So again, when we have a look at a trust deed, that is part of the governing rules of the fund. When I do a pension or start up a pension, that's part of the governing rules of the fund because it's a document that deals with the operation of the fund. And then anything to do with that sort of stuff, investment strategy, again, is classified as part of the governing rules. Now, some of you may not have been here. Let's just jump down to Section 42A and have a look at what is a complying and a non-complying fund. So Section 42 talks about, because this the SIS legislation actually deals with both APRA funds and also non-APRA funds. Section 42 just deals with normal funds. But here, Section 42A, if you haven't had a look at it, and it's pretty important, talks about what a complying superannuation fund is for a self-managed super fund. So it says here, an entity that was a self-managed super fund at all times during the year of income is a complying fund in relation to the division for the purpose of this division if. So the entity was a resident regulated superannuation fund at all times during the year of income when the entity was in existence. And then I'd go back to Section 10.1 to find what a resident regulated superannuation fund is. But for most of them, unless you've got unless it's a foreign super fund, you're generally going to be a resident regulated superannuation fund. And then don't worry about that one. So that just talks about if it's only part of the year. And B, the entity passes the test in subsection 5 in relation to the year of income. So don't worry about these ones, talk about part of the year. Now let's go down to subsection 5. This also, if you come in existence. So subsection 5, so let's go back actually up here, 42A, and then just re-emphasise that, sorry. So the entity is a resident regulated superannuation fund, and the entity passes the test. So we need to make sure that we're passing the test in subsection 5. Otherwise, we're not a complying fund. And again, there's no, generally there's no time limit on which the commissioner can go back. So let's go through and have a look at yourself, your own fund or any of your clients' funds. Let's have a look. So we all have to pass section 5. So an entity passes the test in this subsection in relation to year of income or part year of income if no trustee of the entity can contravene any of the regulatory provisions in relation to the entity during the year of income or the part of the year of income. So that's the first one. So, for example, the commissioner, we've been through this before, the commissioner's got quite detailed guidelines on investment strategies and says that 0 to 100% asset allocation is not an investment strategy. Therefore, there's a breach of section 52B to F. And so as a consequence of that, by putting that in place, it essentially means that the fund hasn't met the test in subsection 5A because it's contravened a provision. Again, one of the regulatory provisions is, of course, the governing rules, which I introduced there. So if there's a breach of the governing rules or the trustee, then again, the fund hasn't met its requirements under 42A5A. So it means it doesn't meet that test. Now, again, we've just got to be careful because whenever an auditor sends a qualification to the commissioner, effectively what they're doing is they're notifying the commissioner that in that respect, the trustee of the superannuation fund has effectively breached the laws, and as a consequence of that, they are a non-complying fund. Now, there is an out here, and this is under section 42A 5B. If a trustee of the entity contravene one or more of the regulatory provisions in relation to the entity during the year of income or the part of the year of income, the regulator, after considering the taxation consequences that arise if the entity were to be treated as a non-complying fund in relation to year of income, concerned with the seriousness of the contraventions and all other relevant circumstances, thinks that a notice should nevertheless be given stating that the entity is a complying fund in relation to the year of income concerned. So with that one, when we have a look at it, we need to really focus in on, because we don't get these notices from the commissioner, where we have breached any trustee rule, any of the regulatory provisions, prima facie, the fund is a non-complying fund, and the commissioner can come back at a later stage and notify that. What happens is, under the laws, section 45 of the SIS Act, is that when we first become compliant, we get our first notice of compliance from the commissioner. Each year, unless something else happens or the commissioner comes back and audits us, each year that fund is to be treated as deemed as a complying fund, although it may well be non-compliant because it hasn't met section 42B. So just be very careful there that when you deal with a client, that in effect, if you are aware there's been a breach and you need to rectify that breach, prima facie, that fund is a non-complying fund. But notwithstanding that is obviously the penalties for non-compliance are a tax rate of 45% on the balance sheet or the market value of the assets in last year's balance sheet. So that's quite horrendous. So there's a good chance if anything came to that, we would, the commission would hardly stop a 52.5B notice. However, we just have to be careful or mindful of that fact. If someone takes an action under 54C, 55.3 or section 218, they don't need the tax office to do anything for that. All they have to do is show that who are aware that the fund was non-complying because there's been a breach of the regulatory provisions, then as a consequence of that, you're going to be sued for any losses that are occasioned of that. And that could have easily been the case under Baumgartner's case, and also Cam and Bear, that the members of the fund, I know the auditor got pinged, but they also could have picked up the advisors to that SMSF as well. It's not well known, but that doesn't mean that it doesn't apply. Let's just jump down to section 128 and more importantly, part 16, and have a look here. So part 16 is, oops, have I got it there? Maybe not. Okay, so obviously they've split it up on me. So if I have a look, what did I do? I don't think I did that. Okay, let me see if I've got my other SIS Act here. So again, Grant got called out on that one. So I'll just go in, have a look at my documents. I've got my holding documents, my 2-day course, and that's where I have my SIS Act. So I've got 2020, so SIS Act. Hopefully this one is the bigger one, so we'll soon find out. So that's popping up. Let's go down, looks like the bigger one. So okay, 55B, remember we had a look at all of that one. And we had a look here. Okay, so we're right in the money here. So this is the bigger one. You can see now it's starting to get so big, they're actually cutting it up into parts. So let's have a look here. So this is part 16, actuaries and auditors of superannuation entities. When we have a look here, we've got Section 128A, application for registration. Now, all your auditors, obviously, you've gone through that process. Registration as an approved SMSF auditor, we've obviously gone through that process. Asic is the one to provide us with the case of the regulator there is Asic, it's not the tax office. We've got conditions, etc. We can get disqualification. You've seen the cancelling. Now, obligations. So when we have a look here and just jump in quickly, you can see here an approved SMSF auditor, remember that's one who's been registered, must completely continuing professional development requirements prescribed by the regulations. So that's obviously going to be the ASIC stuff. Hold a current PI insurance, which is important. Comply with any competency standards the regulator determines. Any auditing standards under the auditing board. So obviously the APSEB that we're looking at is incorporated in there. And obviously here, comply with auditor independence requirements prescribed by the regulations. So again, this is part of the regulations. It only applies to auditors, but again, if we're aware of it, we could end up being there. Selma, I'm not sure if I have a look at, I've had a look at, I could spend a bit of time going and have a look at how many audits we do, but I'm pretty sure once you're an approved auditor, there's no necessity to do a number of audits per annum. But I will go and do some research and come back on it. If there's any smart people in the room, please let me know. So what I've done is I've had a look at the SIS Act. I'm not going to go in to have a look at what happens if we have a breach. What I want to do now is I want to go, before I go to APSEB and have a look at the element, this is a little one for those of you who are planners or licensed. This is one of the standards that we need to meet. So Fnss MS 505, support the trustee in selection and performance monitoring of outsourced services. It's one that's not it's not really taken up, and I certainly know that, for example, the SMSF Association, all those other ones don't really refer to this, but this is part of the financial services training package in the Industry Skills Council, so it's pretty important. It's important because I helped write it way back in 2004. So this unit describes the skills and knowledge required to assist self-managed super fund trustees in establishing a scope and criteria for outsourced services, selecting engaged outsource suppliers, and monitoring the performance of outsourced services. It doesn't require expertise in the functions of outsourced service providers. So when you're dealing with auditors, we need to see how to fill it in. So the elements of performance criteria, first off, let's have a look at the audit. conduct a review to determine the extent to which selected activities are being conducted by trustees or by outsourced services. So obviously it's a requirement under the law to do audit. Identify activities within this fund that can or are required to be outsourced. They have to. Identify legislative requirements relating to required services. So again, once we start to do that, particularly under the licensing, the way it bounces around is we know the legislative requirements under Section 128F talk about independence. So if there's a problem with the auditor and the independence, then it means that if there's been a loss occasioned because of the auditor independence, then the client actually has an action under AFCA against the advisor, because we need to know all the legislative requirements around the auditors. That's why I was saying it's like a can of worms once we start to go into it. We then go down and define the scope of expertise, requirement, establish and document performance standards for provision of monitoring service standards, and that should be the auditor's letter there, the trustee's letter to the auditor. Establish and document measuring processes and all that. Again, this is for administrators. If you're doing administrator, you need to go through the same thing. Assist trustee to select suppliers of its outsourced services against established criteria. Formally engage outsourced suppliers. So I won't go into much. Evaluate performance. So again, there's a whole range of stuff that I'll leave there. So I'll leave that for you when we have a look at the evidentiary. We've got the unit mapping there. When we have a look at the evidentiary, there is that you need to be able to interpret complex detail stuff and all that. So I'll leave that with you. That's basically sitting in there. So let's go down now and bump our way straight into the independence guide here. You'll see this also applies to large public institutions as well. They call them PIEs. But what we're going to do is we're just going to have a look at, there's obviously a lot around the independence guide, assurance engagements, which is just obviously any audit engagement. The frameworks, which I won't spend a lot, but there's identifying threats, evaluating threats, addressing those threats as well. Then when we go down, we have a look at public interest entities, which is generally, well, I don't think I've seen an SMSF that's a public interest entity, but essentially they go through a whole lot of examples, which we need to go through now, and we'll talk through. But that's for public interest entities. What we want to do is focus in on self-managed superannuation funds. So let's go through there. We're going to focus in on here. So I'm just going to peel up to page 79 so that we can start our little discussion there. So you can see I've already been through this for a while. Let's have a look at their opening statements in terms of SMSFs. So self-managed super funds. For self-managed super fund audits, there's no difference in the application of the independence requirements and conceptual framework of the code, which applies under the Corporations Act, from other types of audit engagements. Approved SMSF auditors must comply with auditor independence requirements produced by the APS-ESB and set out in the code as per Section 128FD of the SIS Act, which we've done, and Regulation 9A.06 of the SIS regulations, which I didn't take you there, but that is the one that also requires independence. So the following guidance provides direction in applying the independence requirements and framework from an SMSF perspective. However, the chapter should not be read in isolation from other chapters in this guide. So again, they're not really going to be public interest entities at all. Now, this is an interesting one. There is a misconception the audit independence requirements of the code do not need to be applied to SMSF audit clients, largely because of their relevant size. SMSF generally fall within the small client category as discussed in Chapter 4 of the Code. This classification has a direct impact on the type and significance of independence threats. As an example, close relationships to a client are more often prevalent between small clients, such as SMSFs and their auditor. This can make it challenging to eliminate the circumstances of creating threats to independent or apply safeguards. A legal requirement exists under the SIS Act for SMSF trustees to have their fund audited annually. As a professional accountant SMSF auditor, members are obliged to carry out such an audit in accordance with auditing standards and in compliance with the independence requirements of the code. This applies regardless of the size or simplicity, which we'll have a look at, or level of complexity of the SMSF, the audit engagement, and any perception the fund is otherwise complying with other legal requirements. So this chapter includes a discussion of instances where independence may need to be considered as a consequence of other relationships, so we'll have a look. Now, if a SMSF auditor has any doubt about their independence in carrying out an audit and they are unable to eliminate the circumstance creating threats to independence or apply safeguards to reduce those threats, they must decline the audit engagement. Again, as I said, when we have a look at this, we also need, as the advisor, the outsourcer for the trustee, because the trustee, it's very unlikely that we're going to tell the trustee to go and get a certain auditor. We recommend the auditor. Perhaps here it might be worthwhile for the trustee to have a panel of auditors which you recommend. So scenarios where independence is always compromised. So, for example, here, an auditor cannot audit SMSF where the auditor, their staff or their firm has prepared the financial statements for the fund unless there's a routine or mechanical service, which when you dive in, if we have a look at it, services that are routine or mechanical in nature require little or no professional judgment, and examples are listed in this down below, which includes preparing financial statements based on information the client approved trial balance. So when we have a look there is if your client provides all the accounts up to trial balance, so then you're just looking over it like a helicopter view, then that is routine or mechanical in nature. But as I go on to say, however, even if the service is routine or mechanical, a reasonable and informed third party would likely conclude the threats of independence are not at acceptable level would need to be addressed. So when we have a look at that particular issue, from that perspective is that it's very unlikely for all of our clients, because they just simply don't understand how to put together those financial statements. And there might be out of the 600 or 20,000 SMSFs, there may well only be, probably about 15 or 20,000, which are essentially owned by accountants who could do that. So we've got a concern there. In order to cannot audit their own or an immediate family member's SMSF, which I think is okay. In order to cannot audit the SMSF where a partner within their own firm is a member or trustee of that SMSF. In order to cannot audit the SMSF where they have a business relationship with a member trustee of the SMSF. So we'll go down and have a look. So where an accountant assumes management responsibility for the preparation of financial statements for an SMSF, which is generally the case, that's why you paid admin fees for, then the service would not be routine and mechanical, and the self-review threat which arises were that same firm to undertake an audit of those financial statements would be so great that no safeguard could reduce the threat to an acceptable level. So there's the first one, is that if you, there's no such thing as the Chinese wall, essentially. Now you can go on further and have a look a bit more. I've got a whole lot more to go into. So to avoid assuming management responsibility, the firm must be satisfied trustees make all judgment. Look, that's just not gonna work. Let's move away from those ones. Auditor cannot audit SMSF within a partner, so that's okay. We've got a whole lot of other ones here, including financial planning, a whole lot of stuff as well. So the books are prepared by the auditor. So scenario one, the auditor SMSF is asked to prepare the financial statements of the fund. This includes either the audit recording transaction coded by the client, the general ledger coding and recording. For SMSFs, the audit is prohibited. I think that's easy. So I'm not going to worry about that one. Auditors shouldn't be doing books of accounts for the self-managed super fund. And really, here, look, the auditor may not be able to eliminate the circumstances creating the threat to independence. I think that's pretty obvious there. Carrying out the accounting and or tax role in the audit function in the same firm. So this is the one that, this is the Chinese wall. So let's go through this. Scenario two, a partner within an accounting firm is responsible for the preparation of SMSF's financial statements, which is routine or mechanical in nature. Now, again, as I said before, you're going to have a really hard time because of the very nature of SMSFs, unless someone takes it to a trial balance. that you're going to be showing that. But let's assume that it's the case. The trustees of the SMSF are financially literate and a position to take responsibility for the preparation, fair presentation of the financial statements. Now, at law, if Asic comes in and starts, or a lawyer starts questioning clients around that, and they follow like a pack of cards, then you're going to have problems. Another partner within the same firm is assessing whether to accept the audit engagement for the SMSF for the year. Now, this is important. The SMSF's investments consist of blue chip shares, deposits, and bank accounts. And really, to be brutally honest, if the client is going to do all the work and all the financial statements and management, why would you be administering them anyway? Because there's virtually no fees unless you're picking up on the audit fees. So self-interest. So these are the threats: self-interest, self-review, and intimidation. So as a threat to the audit partner's financial interest in the additional fees from the preparation of financial statements will inappropriately influence the auditor's judgment or behaviour. But I would have thought that that's the case for everyone. So a self-review, as the auditor is required to audit financial statements prepared by another partner in the same firm, there's a threat that the auditor would not evaluate the results of judgments made by the other partner in preparing the financial statements. So here, the auditor must exercise their professional judgment, use a reasonable informed third-party test in determining whether the identified threats are at acceptable level. So remember, this is, one is whether the firm has assumed any management responsibility. As the SMSF trustees have the capacity to take responsibility for preparation and fair presentation of financial statements, this is likely as assumed management responsibility. But if you assume management responsibility, then you can't do the audit. That's the first one. Now here they're actually saying, well, hold on, the client's got it. So this is, I would have thought it's going to be a limited case. But again, if we have a look there, they're still saying there's potential whiff of non-independence there, and you're going to create a threat. It's interesting when they go down here, larger firms may find it easier to apply appropriate safeguards to reduce threats to an acceptable level in addition to preparation of financial statements. Generally, the larger firm it will increase the firm's ability to segregate the activities for different services. So this is quite interesting. With relevant ethical safeguards, it is possible for a larger firm to carry out the accounting and audit work for SMSF. However, this can only occur where the accounting services are routine or mechanical. So that's the big, what is that routine and mechanical? And there's segregation. For example, they go into separate business divisions. However, then they say smaller firms with 2 or 3 partners would find it difficult to put those in place. Change in circumstances during the 2000 and whatever year, the SMSF trustees divest a large portion of the SMSFs and invest in racehorse, artwork, blah, blah, blah. The trustees are no longer in a position to take responsibility. So again, that responsibility is going to depend on the underlying assets. So again, it's going to be very interesting to see whether you get in that. Look, a staff member within a sole practitioner accounting firm who prepares the financial statements based on client trial balance for an SMSF, the service is determined to be routine or mechanical. The sole principle is assessing whether to accept the audit engagement. So look, self-review. As the auditor is required to audit the financial statement prepared by one of their staff members, the threat the auditor would not evaluate. So again, look, you just don't here. The auditor cannot eliminate the circumstances creating the threat. So again, what they're doing a software just saying you can't do that. This is interesting. Accounting firm acts as a tax agent for an SMSF. They assist the SMSF client in preparing their tax return and tax calculations. And essentially they go down and they look at acceptable level. So preparation of SMSF annual return where the client takes responsibility will not generally create a self-review threat, where other tax services, including tax calculations, could create a self-review. So they give a bit of an out there for tax. If the accounting firm prepares tax calculation and current deferred tax liabilities, that may have a material effect, but that's not the big one. Okay, so this is an interesting one. Carrying out an SMSF audit where the auditor was previously a consultant partner or employee of the firm. I would have thought, well, gosh, if they're no longer with the firm, then you'd be okay. So when they go in, we've got here, an auditor has been approached to conduct let's say it's 2020 audits for clients of a firm providing accounting and tax services. The auditor is previously a partner of that firm where they provide accounting service and advice to some of the firm's clients. Finished working in the firm 12 months ago. What do you think? Would they be independent or not? Acceptable level. So the first one, threats may exist. The auditor may not appropriately evaluate the results of the previous judgments made or advice provided to clients of the firm with the auditor. The risk would also likely apply if the auditor was a previous employee or consultant. A familiarity, which is a risk. Due to previous relation, there is threat the auditor may be too accepting of the work of the firm they previously worked at. So again, after a staff member leaves the firm, a partner retires, they are sometimes asked to undertake the audit role. Some firms may regard this as outsourcing the audit work for their SMSF clients. Remember, we looked at that, to a third party, therefore relieving themselves of any threats to independence. However, prior to accepting the audit engagement, the auditor as previously a partner will still need to assess their independence. It's important to understand that outsourcing SMSF audit activity does not guarantee independence. An auditor must assess their independence on each and every audit engagement. If the auditor now works in another firm where there are other partners who can undertake SMSF audits, threats could be eliminated if one of those other partners undertook the audit there. So again, that's important. Now here, referral. An auditor is asked by an administration firm to accept the audit work of multiple SMSF clients. The fees generated with this work effectively double the fee base of the auditor. So what do you think with that one? That's probably where a lot of us are with some of our clients. There is a threat that the auditor's financial interest in doubling their fee base from the referral source will inappropriately influence their judgment or behaviour. For example, the auditor may be reluctant to issue an adverse finding for fear of losing this referral source. So acceptable level, what is acceptable? Where a large proportion of the auditor's fees come from one referral source, the auditor must evaluate the significance of the threat and apply safeguards where necessary to eliminate the threat. There's potential dependence on the referral source and concerns related to retaining the audit clients. Now, there's no way in the world you'd be giving referral fees back to the account. That's just not going to work. We're just talking here that the size of the fee base in itself may endanger the independence. So when we have a look at, although the audit engagement is an arrangement between the auditor and the SMSF trustees, the reality is the number of clients being referred from one source. Consequently, the auditor will need to consider the possible impact of reliance on one referral source on auditor independence. Remember, auditor must be independent both fact and appearance, and dependence on a referral source can create a perception of impaired auditor independence. So we had a look at that. So again, in other circumstances, referral source could be significantly audited for qualitative reasons to create threats to independence, even if the referral source only represents a small percentage of their fee base. For example, the auditor may have just commenced a new practice and obtains audit work for some clients of a prestigious accounting firm. Again, you can start to see it. So here, the auditor may not be able to eliminate the circumstances. So isn't it nice that your association did this to you anyway? So what are some of the safeguards? Specifically address fees and appropriate safeguards. So increase the auditor's client base to reduce dependence on the referral source. So is that going to happen down the track? Having an appropriate reviewer who did not take part in the audits to review the audits. So that's probably a third party. But again, if you're going to get a third party, why would you do it in the first place as well? Threats to independence may be further exacerbated if the referral source is a former employer of the auditor, or the auditor also receives referrals for non-auditor work from the same source. So again, if there's a sizable fee base there, then again, we've got this independence issue. As you can see, we're starting to get really tight, and it gets worse here. An auditor is asked by an accounting firm to accept the audit work of their SMSF clients. The principal in the accounting firm is the auditor's son. Well, we won't even worry about that one. That's obviously just blown out of the water. Here's the old one. Remember, I had a look at the start, the reciprocal. Reciprocal auditing arrangements can occur where two SMSF auditors audit each other's personal SMSF, or where two professional accountants that are also SMSF auditors each have SMSF clients prepare the financial statements for their respective clients, then enter into arrangements to audit each other's clients' financial statements. These arrangements are of concern to both the ATO and Asic. So member A and B each have their own personal SMSF. Member B agrees to audit SMSF and agrees to audit B's SMSF. So obviously there's going to be an issue there. This is probably the big one. Auditor A has 50 SMSF clients. Auditor B has 60. Auditor A and B enter into a reciprocal arrangement. Auditor A audits B's and B audits A's. There is a threat that this referral arrangement will inappropriately influence the auditor's judgment or behaviour if they depend on the fees. For example, it may lead to the auditors being reluctant to issue adverse findings due to risk of losing all these clients. This could also create a threat, as members may not want to risk losing the auditor of all their SMSF clients. Familiarity, intimidation. There's a threat the auditors will be deferred. I mean, once you start to see polling these sort of things up, there's obviously huge risks. So acceptable, as each auditor is auditing all of the SMSF clients of the other auditor, this creates a significant reliance from both a qualitative and quantitative fee. As such, a reasonable informed third party would consider the threats of independence in this situation would not be acceptable. Okay, so basically that's out the door. Appropriate safeguard will be to spread out the referral clients to a number of different SMSF auditors. So effectively, if you're doing one lot of reciprocal arrangements, you are basically stuffed. Regional areas. Okay, so this is pretty important. Let's have a look at what they're saying. SMSF Audit in Country Town of Victoria receives referrals from 2 local professional accountants who believe it's too hard to access other auditors. The accountants and their SMSF clients also prefer to use the auditors they know. I would have thought this is just a pretty typical one, particularly for those people out in the regional community, and more importantly, when you're in a lockdown. There's a threat that these referrals, so we're having self-interest, familiarity, intimidation. So again, it's going to be the same thing. It's all the same thing as we talked about before. Same considerations as in 6 before. As the auditor is receiving referrals, estimates of clients from 2 local accounts, either or both of these referral arrangements may represent a large proportion of the auditor's total fees, create a dependency from both a qualitative and quantitative. As such, a reasonable informed party may consider the threats to independence are not acceptable. So the auditor may not be able to eliminate independence. So once you have a look at that, it's sort of like saying, look, it's very hard for you to get across that. So an appropriate safeguard would be for the auditor to increase their client base and referral sources to reduce dependence on 2 local accountants and their SMSF clients. The auditor could broaden their referral base from other surrounding country towns. This could be coupled with reducing the referral of clients from 2 local accountants. It's just honestly, it's just a tough one to do. Apply safeguards. Living in close community may actually increase threats to independence due to close. Look, anyway. Now, this is a nice one. I thought you'd like this one, Tim. It's a bit nasty. Firms offering financial planning services. So a partner within a firm that offers financial planning services is assessing whether to accept an audit engagement for SMSF to whom financial planning services are supplied by another partner in the firm. There is a threat as the firm's fees may be directly linked to that financial planning advice provided will inappropriately influence the auditor's judgment or behaviour. So self-review, obviously, there's the same issues we before. Financial planning service can offer a particularly independent challenge for firms where they wish to offer SMSF audit service to the same client. In order to must exercise a professional judgment, use reasonably informed third party. So the remuneration structure the firm uses for financial planning advice may increase the self-interest threat and place an auditor at particular risk of a breach of independence. However, it's not the only factor that needs to be considered. Depending on the age of the financial planning service provided, there is likely to be a significant amount of professional judgment in the provision of those services. As a level of professional judgment increases, so does the self-review threat. If an auditor is assessing compliance with validity of a particular financial product or investment management, so look at investment strategy, it may be perceived the auditor would not be independent in undertaking their role. For example, if a limited recourse borrowing arrangement has been recommended and set up for an SMSF client by the firm, the auditor may not be independent in making assessment whether the arrangement is compliant or has been correctly set up. So again, may not be able to eliminate. So the safeguard, there is no exhaustive list of types of scenarios which financial planning services pose a particular problem for audit implying safeguard. So that's a nasty. Where a firm is receiving remuneration as commission or asset-based remuneration like a 1% funds under management, appropriate safeguards are unlikely to be available. A genuine fee-for-service model may reduce the level of threats to independence. However, an auditor would still need to approach independence in a similar manner as when the firm. So this is probably much the same as the Chinese walls. If you're doing financial planning inside the firm, again, you're sort of stuffed. Auditors contracting out accounting work. So the auditor uses a contractor. There's a professional accountant and tax agent prepare the SMSF, then audit confirms the audit. So again, have a look at that if you're an auditor. That's pretty crucial in there. But again, that you can start to see that there's this Chinese wall of independence. This is an interesting one. God, how many scenarios have I got? The auditor has a small client base in regional New South Wales. I don't know. Obviously, they've been picking on someone in New South Wales. Has been undertaking XYZ for excess of 10 years and no internal or external independence review has been undertaken. A threat may be created where the auditor is concerned about losing XYZ SMSF as a client relationship. Due to the, isn't this crazy? Due to the long relationship with XY, its trustees and financial statements are being audited, there's a threat that the auditor will be too sympathetic for their interests. And again, example of an action that might eliminate the self-interest of familiarity threats would be to rotate the auditor off the engagement. However, this would depend on the size of the firm. So when we have a look at that, that's the core stuff for us to have a look at. And I think the main one is that when we go into this deep dive, it's not just the that independence review, but it's also the impact of the Corporations Act, its impact of the SIS Act, its impact of even just the governing rules and whether they're being breached. From my point of view, and again, I've only just done a deep dive here, and I probably was a little bit shocked on the size of audit fees may actually show up independence issues. The Chinese walls, yeah, look, I understand that. The financial planning, preparation of financial statements. It's going to be very hard to say that you are not involved in the management of the fund, particularly if you're an administrator. That's the whole purpose of being the administrator of the fund. So the upshot, if you're looking at doing, this is the way that I see it forward, is that either clients choose from a panel of independent auditors. Alternatively, there is one firm that does the audit and they're just solely just an SMSF audit firm, and then they rotate the auditors so you don't have that recognition over a period of time, or there is no specific audit partner. For you guys as outsourcers, you can see there's quite a lot of work under Fnss SMSF 505 in terms of vetting auditors and outsourcing and all that. So it's probably best to, again, keep far enough away. Make sure that you do go, obviously, for the best auditors. The auditors are well aware. Maybe even have a tender, particularly if you've got like 200 to 300 funds. Go and have a look and look at here at obviously I love it SMSF. I'm more than happy to go in and have a look and help you through this process there, or give me your stuff for me to have a look at to see whether there are independence issues there. I mean, it's part of the service, and if need be, we can do a letter of advice there. But again, just be really careful there. It's not so much the independence issue that we're concerned about. It's the fallback from AFCA. It's also the fallback under 54C and also Section 55.3. Anyway, look, if you need any questions at all, please come back to me. Good to see you there, Mrs. Rourke. Haven't heard from you for a long time. Give us a call at some stage. I'll have this recording up with all of these, all the relevant legislation a little bit later on this afternoon. Anyway, it's Grant Abbott signing off.